Hey everybody, welcome back to Chip Stock Investor. Hope you're having a great day so far. We're going to be reviewing our top non-chip stock picks of 2024, how they did, and whether or not we're going to keep them in our portfolio or as our top picks in 2025. We did this recently with our top chip stock picks of 2024. We'll link that video right here if you haven't caught it yet. We did pretty good on that. Not bad, 45% on an equal weighted basis.
Yeah, we beat the index, not just the market overall, but the index. And with this list of picks, we beat, it's probably not a fair comparison to say this is a NASDAQ 100, NASDAQ composite basket of stocks, but we're just going to go with that as a benchmark. And we narrowly beat that this year too. So we're pretty happy with how we did. And of course, these are just the picks that we made at the start of 2024. We'll have the links to both the top chip stock picks at the beginning of 2024 and the non-chip stock picks at the beginning of 2024 in the description below if you aren't sure where this list came from in the first place.
Before we review all of those companies, make sure you hit the subscribe button to the channel, share this video with your friends, hit the like button, and check out our Semiconductor Insider membership. That membership gets you access to all of our research, including these top stock picks that we did for 2024. We're going to do the same thing, but not in a video form in 2025. So only on Semiconductor Insider. Check it out in the link below.
All of our research is not able to go into video format. Actually, I should say the vast majority of our research is not able to go into video format. Maybe someday that can happen when we have a big, giant production team. Maybe we'll outbid Elon Musk for MSNBC, and then we'll be able to do things like that. But until then, Semiconductor Insider is where you can find everything that we do and what we're buying and selling before we do it. Okay, without further ado, let's talk about the first overall pick that we made for the start of 2024.
First company was Amazon. And Amazon did pretty fantastic, really. 55% year-to-date total return. Nick, what was your thesis for this one?
Well, not a lot of introduction needed, but we thought that the e-commerce business was going to turn profitable and AWS was going to begin rebounding. AWS being the cloud computing portion of the business that really actually pays the bills. But overall, we said that profit margins were going to rise, especially as the e-commerce business got itself fixed, right-sized, whatever you want to call it. And Amazon definitely delivered on that front. It doesn't matter if you measure profitability from operating income, GAAP net income, cash from operations, free cash flow, whatever. Amazon's profit margins really took off this year. And we actually think that will continue in 2025.
We were very happy with Amazon's performance in 2024. It's a core holding in our portfolio, and it will remain that way going into 2025. Let's talk about the second company, Salesforce. Salesforce had a 40% year-to-date return, had some bumpy months there in the summer, but powered on through and came back with a vengeance at the end of the year.
Yeah, we can thank AI, specifically Salesforce's new AI agents. Mark Benioff, the CEO and co-founder, really one of the pioneers of the whole cloud computing-based software revolution in the late 1990s, really going after Microsoft on this AI agent thing. So that's probably a large part of the stocks rally this year. But much like Amazon, we've had this one for a long time. Our thesis all along was that profit margins, especially on a GAAP basis, the market really wanted to see GAAP profitability from Salesforce. We thought that they would have the ability to deliver on that front, and sure enough, that's exactly what happened.
As an alternate pick to Salesforce, we said ServiceNow would also be a top software stock going into 2024. And it actually outperformed Salesforce, 64% year-to-date return.
Yeah, as you said, with Salesforce, some bumpy months there, especially in the summer for ServiceNow. A lot of this has to do with the AI capital expenditure worries that Wall Street has had. Enterprise software companies like Salesforce and ServiceNow obviously having to spend some money on GPUs to get new AI features crammed into their software suite for customers. But ServiceNow has done exceptionally well has continued to grow at a north of 20% revenue growth rate all along, and profit margins continue to expand as well. So good stuff between those two, even though it was kind of a bumpy year for enterprise software, things heated up the second half of the year.
We really feel like 2025 could be a great year for software companies. And so we're very happy to continue having Salesforce as part of our core portfolio.
But for us personally, Salesforce, I don't think we're going to make a top pick again for 2025. We're just kind of in hold mode on this, but we'll be talking about a lot of other enterprise software companies as the year progresses and as we see opportunities for ourselves personally arise, and when we have something we think is meaningful to say about enterprise software companies. So stay tuned for that. For the next two picks, let's maybe pivot away from enterprise software and talk about more consumer-facing software in the form of online travel booking companies, Airbnb and Booking Holdings.
If I'm being completely honest, I'm kind of surprised at Airbnb's performance this year. It ended up, at least at this time that we made this chart on December 17th, down 2% year to date, basically back where it started at the very beginning of the year. It had that early in the year rally and then just kind of fell off a cliff, especially after summer. Comparing that to Booking Holdings, they did have a few bumpy months, but ended up 49% up on the year. One of the main reasons that there's this vast difference in stock price action, especially, is that Booking Holdings was a better value.
Mm-hmm. Absolutely. Yeah, both companies actually are kind of dealing with I want to call it a slowdown in consumer spending on travel. It's more like normalization of consumer travel trends again as the year has progressed. And you're exactly right, Casey. We called this out on Airbnb after the first kind of fall off in the stock price back in May. We've been discussing this for over a year now, but Airbnb was getting a big income tax benefit in their GAAP net income metrics that fell off in Q2 of 2024. And it seems like, even though it's been talked about, I think at this point, quite extensively, the market was still not anticipating that. And so Airbnb stock re-rated lower. And by contrast, like you said, Booking Holdings was just a better value to start the year. On a price to free cash flow basis, especially, Booking was well under 20x trailing 12 months price to free cash flow at the start of the year. And then that valuation has kind of re-rated higher throughout the year as their profit margins also expand as they continue to get high single-digit percentage revenue growth rates. So still fantastic businesses, both of them. But if we're zooming in on the short term in just the last year, that's why there's such that wide divergence between the two stock price performances. The businesses themselves are doing very well, in our opinion.
Booking had a fantastic year. Airbnb, not so much. I think that we're both of the opinion that Booking will not be able to sustain the same growth in stock price percentage over 2025. Airbnb, we're still pretty positive about going into 2025.
Yeah, I think the one thing that we're looking for on Airbnb is that continual increase in profit margins. We see no reason that they can't achieve the same very, very large profit margin percentages, 30%, 40% plus, that Booking Holdings has today on both a GAAP basis and a free cash flow basis. So we think that's the story to watch for Airbnb in 2025. We're still very happy to continue holding this one, and I imagine we may nibble on that one on occasion throughout this year. Okay, Casey, I want to now introduce a particular industry that is near and dear to your heart, shoes, and you picked one especially good shoe stock as a top pick to kick off 2024.
I'm on a roll in 2024.
You really are. Yeah, see the chip stock video as well. Casey crushed it this year.
On running, up almost 118% this year. Fantastic growth for On Running.
Yeah, pretty simple. Brand awareness continues to increase as they expand to new spots on the global map, especially in emerging markets. And again, despite some consumer spending normalization, especially in the United States and in North America, the key market for On Running, as most consumer-facing brands are. They count the United States as a top market. On Running's international expansion has been going quite well. And this is also a classic case of revenue plus margin expansion along the way as they successfully expand their reach.
I still really love On Running. Of course, they're the only running shoes that I wear. But as far as the stock price continuing on this growth trajectory, I don't know that I see it having 118% return next year. However, as Nick said, they're expanding into new markets. Their growth in those markets is very, very positive. So On Running will still have its place in our portfolio in 2025.
By the way, Casey received no payment to say any of that for On Running. She just really legitimately loves her On Running shoes.
No, Zendaya is getting paid, not Casey.
Neither was Casey paid to talk about the next shoe stock pick. This was actually my stock pick in the shoe department, but Casey really likes her Crocs and her Hey Dudes as well. This was a market underperformer at 16%, although earlier in the year, things were going quite well for Crocs.
Yeah, things were looking absolutely fantastic for the vast majority of the year. Only ended up 16% year to date total return, which is kind of a bummer, but it seems like we're focusing again on Hey Dudes.
Absolutely. I think earlier in the year, the market, probably more than anything, at the beginning of the year, the market recognized along with us that Crocs stock might be a value. And then also in tandem with that, I think there was anticipation that the Hey Dude acquisition and some of the issues that have happened, Crocs kind of flooded their wholesale and retail partner channels with too much inventory in the first year after that acquisition. There was some anticipation that maybe the Hey Dude's inventory excess was going to get burned off sooner than later. And it's taking a bit more time to get that inventory right-sized. I think that's the story in a nutshell. How do you feel about Crocs for 2025, though?
I'm still wearing them. I'm sort of hesitant to say that Crocs is going to be a top pick for 2025. However, it still looks very, very undervalued. As you can see, most of the year, Crocs did fantastic. And with this Hey Dude acquisition hopefully normalizing at some point this year, it could be a really, really solid pick.
Yeah, it could be a big winner, even in spite of decent-ish stock price growth this year. The stock is back under 10x, definitely under 10x trailing metrics, and as well on forward metrics, and pretty much every profit metric you can imagine. It's at or below 10 times. The market has this one priced pretty pessimistically, so at least Croc stock has that going for it in 2025.
International brand recognition is going to continue to be a big deal for Crocs.
Yeah.
Now it's time to talk about our real dud, Arcadium Lithium. It was a lithium stock. So if you have been following lithium at all, you know that basically all of those companies kind of fell off a cliff. This lithium company, the product of a merger between Allchem and Livent, that merger finished up in early 2024. And just in October, Rio Tinto announced that they are going to be acquiring Arcadium Lithium. Ultimately, Arcadium ended up around 32% down on the year.
Yeah, we got bailed out a little bit by Rio Tinto. The problem with this is we called the bottom in the lithium market in demand for lithium, especially for electric vehicles, too soon. Perhaps you're hearing a trend here at this point. There was a broad, across the board slowdown in consumer spending in travel, in purchases of products, of purchases of vehicles, you name it. At the very least, there was a slowdown in consumer spending. And so lithium demand didn't come back as quickly as anticipated. We called it too early. At this point, though, we don't own Arcadium Lithium anymore. After the acquisition by Rio Tinto was announced over on Semiconductor Insider, we talked about how it was time to exit this one, but we still own Albemarle and are more than happy to continue holding that as our top lithium stock pick headed into 2025 as well.
Okay, let's move on to our final stock pick, Shift4 Payments, up 41% on the year. You can see that it was actually really sluggish until about September, and then it started to actually climb. Why is that?
Yeah, check out the video that we did. I think this is the most recent video that we did on a non-chip stock that was a top pick for 2024, the market still has some apprehension about Shift4's acquisition strategy, where they kind of lever up the balance sheets. They take on a substantial amount of debt to purchase these assets that are essentially broken or not generating the revenue and profit that Shift4 thinks that they can. They plug them into their ecosystem, and then voila, after about 2 years, they start generating lots of cash. But that strategy, think of it almost like a private equity type of strategy in digital payments, kind of causes Wall Street some problems in trying to figure out just how profitable Shift4 can eventually be. But it looks like it's another one of those businesses that could be very, very cheap on a forward-looking basis. And maybe the market is starting to recognize that finally, but the amount of debt that they have on balance is still going to be one of the primary headwinds here. Lots more debt than they have cash, and that's just not going to sit well with a lot of investors. But if you think of this in terms of kind of like a private equity type of business, it starts to make a little bit more sense, but it's a risk worth noting.
Plus, kind of cool, the CEO, Jared Isaacman, is now going to be the head of NASA. And he's been to space. He's like actually been to space this year. It was a big year for Shift4 and Jared Isaacman.
Yeah, who knows what that means for Shift4 shareholders, but we'll see. We'll find out. Time will tell.
In summary, let's go ahead and take a look at our total return on an equal weighted basis for our non-chip stocks here at Chipstock Investor. Around 39% total return year to date.
Yeah, we again narrowly beat the NASDAQ composite by a couple percentage points or QQQ. Not massive outperformance on an equal weighted basis. We'll let you imply what that means for our actual portfolio. We are not equal weighted across all of our stocks. They tend to be more heavily weighted towards larger businesses, but there you go. There you have it. We're happy with where we ended up on the year. And if you want some more discussion on these and everything that we bought in 2024 and what we're going to be buying in 2025, don't forget Semiconductor Insider. And we will be talking about our core portfolio holdings over there, both in the chip stock department, of course, and in the non-chip stock holdings department as well. We had some funny things happen this year with some of our smaller bets, like App11, officially our fastest business to 10x ever. Kind of weird 2024. Anyways, we'll take it. We're happy with that.
Especially with a business called App11.
I've actually come to like it. It's been growing on me.
I'm not there yet. So Nick, do you have any thoughts on what our top non-chip stock pick of 2025 might be?
Yes. So we've been discussing over on our live Q&As on Semiconductor Insider about expectations for 2025. There is this general expectation that earnings growth across the entire market finally start to rebound in 2025. It won't just be this skewed earnings growth or earnings recovery like what tends to happen at the beginning of a bull market where one business or one specific industry, semiconductors, kind of lead the way higher. 2025 could be one of those years where lots of businesses return to earnings growth. So at this point, just to keep it simple for investors that may not know where to put money to start 2025, consider a high performance ETF. For example, Vanguard Information Technology ETF, VGT. That's our largest ETF holding in our portfolio. It gets you broad exposure to mega cap and large cap tech stocks, as well as a lot of mid cap and small cap businesses as well that could be those next big giant players, the big giant growth stories in the making in the course of the next 5, 10, and 20 years. So that might be a good place to start for 2025 if you have that expectation that a lot of businesses return to robust earnings growth.
Thanks everybody for watching this episode. Make sure you sub to the channel. Check out Semiconductor Insider in the video description below if you want more access to all of our content. And we'll see you again very soon here at Chipstock Investor.